10 professional analyst reports landed on the Singapore Exchange this week, loaded with loud buy ratings and grand growth narratives. If you are managing a retirement portfolio built for steady monthly distributions, those headlines contain a serious warning. Out of all 10 public broker calls, exactly one survived the hard gates of my forensic balance sheet screen. This is one of those pieces where I had to run the data twice, not because the numbers were complicated, but because the broader backdrop made me want to be certain. With geopolitical pressure building in a key energy corridor and bond yields sitting at levels that change the calculus on every yield-bearing asset, this is precisely the environment where a conservative forensic screen earns its keep. 10 Singapore Exchange broker calls this week came with loud buy ratings and grand growth narratives, but exactly one survived the hard gates of the forensic balance sheet screen. This framework is built strictly for wealth preservation and dependable drawdown income, not momentum trades that could derail 20 years of compounding. Retirement-grade investing is different. It is not exciting. It is disciplined, forensic, and designed to still be working when you need it most. We focus on real cash today because your utility bills cannot be paid with projected long-term earnings. Let us see what the big broker firms are leaving out of their brochures. The June 2026 broker activity table covers 10 names across 5 brokers: RHB, DBS, Maybank, Phillip, and KGI, all sourced verbatim from public research reports via sginvestors.io. Look at the rating column carefully. Most carry bullish language, implied BY initiate, BY maintain, positive. Only one counter, Valuatronics from Phillip, carries a mixed verdict, and of all 10 reports, exactly one published a hard target price, AEM at $11.80 from DBS. Every other target column reads N/A. That tells you something about how much conviction is actually sitting behind these calls. No forensic classifications have been applied to this table yet. That comes next. And here is what stands out. Not a single real estate investment trust made the broker list this week. RHB was the most active broker with 4 reports. Out of all 10 public research documents, only a single explicit target price was published, which was AEM at $11.80 from DBS. Institutional attention has rotated aggressively toward growth and infrastructure names across industrials, transport, consumer, and property. Filtering the noise means accepting that not all 10 names belong in a retirement income conversation. City Developments and First Sponsor Group are property developers with no guaranteed distribution structure and lumpy development cycles. Tyson Electric's 4% projected yield fails our minimum hurdle on face value. Food Empire is a consumer growth story that does not fit a dividend blueprint, while AEM has zero dividend angle and fell nearly 8% in the week ending June 5th. Finally, OKP Holdings and Valuatronics present insufficient public data for a reliable screen. That leaves exactly 2 counters for full forensic scrutiny this week. We have ComfortDelGro and Sembcorp Industries. Both operate in yield-adjacent sectors, both have positive institutional coverage, and neither has a prior zone verdict in our tracking registry. Both will receive the full forensic treatment right now. Turning our attention to ComfortDelGro, the broker case from RHB points to an attractive entry. An expected 5% yield for the financial year 2026, a cleaner vehicle fleet, and protected transport fares. The stock is currently trading at $1.29, down 17% from its 52-week high of $1.55.5. Looking at the hard gate results for ComfortDelGro, the financial metrics clear our thresholds cleanly. The dividend yield sits at 6.6%, which clears our minimum hurdle of 4.7% and our Zone 1 threshold of 5.5%. The gearing ratio stands at 29.7%, below our 30% ceiling. The interest coverage ratio is 6.6 times, well above the 4 times floor, and the net debt to EBITDA ratio is a clean 1.3 times. The valuation layer for ComfortDelGro reveals a significant forensic gap. The broker consensus target price compiled by Beansprout as at June 7, 2026 sits at $1.52. Compared against the current market price of $1.29, the stock is trading at a 15.1% discount to consensus. However, we have to look at the soft flag on the screen, which is free cash flow. Free cash flow turned negative in December 2025 at minus 114 million Singapore dollars. This was driven entirely by a heavy capital expenditure program of $565 million for the electric vehicle fleet upgrade. Free cash flow is the number that tells you whether a dividend is paid from real earnings or from a business stretching beyond its means. Under the version 2.7 classification, ComfortDelGro's portfolio role is dividend income with capital recovery potential. It receives a pass for both the accumulation and transition stages, while the drawdown stage remains conditional. The next review trigger is the August 19, 2026 earnings release, where free cash flow recovery is the primary mandatory watch item. A positive trend opens the Zone 1 conversation. As a result of this screen, ComfortDelGro is placed firmly into Zone 2 as a watchlist counter. For a 58-year-old investor in Bedok managing a supplementary retirement scheme drawdown portfolio, a 6.6% yield clearing every hard gate with gearing below 30% is a rare find. The single open question is whether that negative free cash flow is a temporary capital drag or a structural decline. The August results will tell us. This is a rare moment where institutional broker enthusiasm and forensic balance sheet discipline point in the same direction. A 6.6% yield gearing below 30% and an interest coverage ratio of 6.6 times provide a comfortable cushion for retirement capital. The only soft flag is the time-limited capital expenditure for the electric vehicle fleet conversion. When that investment cycle completes, free cash flow normalizes and the path to Zone 1 opens. August 19th is the date that decides it. Moving on to Sembcorp Industries. The institutional case from Maybank highlights a massive 2.6 gigawatt independent power project in the United Arab Emirates. This includes a 29-year power purchase agreement that completes in 2029. Brokers view this long-duration income anchor as a powerful commercial catalyst. When we run Sembcorp through our layer-by-layer screen, the problems begin immediately. The dividend yield is 4.1% at a share price of $6.13, which fails our mandatory 4.7% minimum hurdle and underperforms the Central Provident Fund special account rate of 4% once transaction costs are applied. Here is why that matters. In a forward scenario, a 10% drop in global energy costs would soften wholesale prices, putting that dividend under further pressure. For a 62-year-old investor in Torpeo, accepting heavy infrastructure execution risk for a yield below the hurdle means this asset is working against your retirement purpose. The balance sheet breaches for Sembcorp are severe. The gearing ratio sits at 52.8%, which represents $9,738 million of debt against $18,429 million of assets, breaching our 35% ceiling by nearly 18 percentage points. The interest coverage ratio is just 2.5 times, falling well below our 4 times floor. Finally, net debt to EBITDA is 5.9 times, crossing our yellow flag caution threshold and implying it would take nearly 6 years of current operating cash flow to clear the net debt. Sembcorp triggers multiple soft flags, led by a clear revenue contraction over 3 consecutive periods, falling from 7,042 million to 6,417 million, and down to 5,799 million Singapore dollars. This represents a cumulative decline of 17.6%. On valuation, the consensus target sits at $6.76, meaning the stock trades at a 9.2% discount, so the trading above fair value soft flag has been removed. Sembcorp is assigned to Zone 4 under our caution classification. Its portfolio role is a speculative infrastructure play, and it receives a straight fail for the transition, accumulation, and drawdown stages. The next review trigger will be the half-year 2026 results on the Singapore Exchange, where we must monitor for balance sheet deleveraging and interest coverage ratio improvements following project milestones. Some investors ask why the 4.7% hurdle still applies to dollars outside the Central Provident Fund system if their special account is already maxed out. The answer is simple. The hurdle is not about the Central Provident Fund. It is the minimum return that justifies taking open market risks. Gearing risk and distribution cuts do not get cheaper just because you have run out of guaranteed options. The market does not give you a discount for exhausting your alternatives. Remember, a Zone 4 verdict is a timing signal, not a permanent rejection. The investment thesis changes when the yield clears the hurdle, the balance sheet deleverages, or the price corrects to a point where the mathematics make sense for an income investor. Until those conditions are met, the forensic framework holds firm. The forensic gap here shows 2 entirely different perspectives. Maybank looks at the 29-year power purchase agreement and sees a rock-solid, long-duration income anchor, noting that the market is underpricing the United Arab Emirates project's eventual contribution 3 years away. But the forensic screen asks a more immediate question. Can the balance sheet protect your retirement capital while that debt load is being carried today? We must invest based on the balance sheet that exists today. A 52.8% gearing ratio is the debt load being carried right now, not a projection about 2029. A 29-year contract does not repair a thin 2.5 times interest coverage ratio today. An excellent commercial outcome down the road does not make a 4.1% yield adequate for the structural risk profile accepted by an income investor right now. While the institutional desks are right that the United Arab Emirates project is commercially significant, a retirement portfolio cannot run on forward-looking growth narratives. When a company carries debt exceeding 52% of assets, records revenue contracting for 3 consecutive periods, and offers a yield below our minimum hurdle, the margin of safety has disappeared. The project completes in 2029, but your retirement income must survive until then. The window is already open. In this market, it closes fast. The difference between a financial sanctuary and a dangerous yield trap is often decided in a single trading session. By the time this analysis reaches you as a free subscriber, the entry window has already opened and often closed. Iggy's elite investors don't just get the report earlier, they get the numbers when they still matter. You get zero-day forensic breakdowns, the full red zone watch list, and institutional-grade cheat sheets at the exact moment the setup goes live, not after the market has already priced it in. For $9 a month, less than a kopi and kaya toast set at Raffles Place, you stop being the exit liquidity and start being the analyst. Reviewing the financial health checklist side by side, the contrast between our two targets is stark. ComfortDelGro clears our yield hurdle at 6.6%, carries a safe 29.7% gearing ratio, and holds a strong 6.6 times interest coverage. Sembcorp fails the yield hurdle at 4.1%, triggers a gearing alert at 52.8%, and falls below our interest coverage floor at 2.5 times. When reading this checklist, remember that these are not soft, optional guidelines. They are hard, non-negotiable thresholds. A single failure on dividend yield, gearing, or interest coverage is enough to push a stock completely out of Zone 1 or Zone 2 territory, regardless of how highly an institutional broker rates it. The framework is built to spot these structural alerts before they become a retirement income crisis. If you need a better deep dive, remember to check out my Substack where I go deeper into the numbers. The way I rate every stock is broken down into 5 distinct defensive zones. Zone 1 represents a financial fortress clearing every hard gate with 0 soft flags. Zone 2 is our watch list, passing all hard gates with at most 1 soft flag. Zone 3 means conditional suitability where multiple soft flags are present, while Zone 4 highlights a clear caution due to a hard gate failure. Zone 5 is the red zone, representing structural balance sheet failure where capital risk cannot be justified at any price. Our dividend trajectory audit highlights that a high headline yield today means absolutely nothing if the distribution cannot be sustained by cash flow. ComfortDelGro shows a solid record of consecutive dividend increases in 2024 and 2025, though its capital expenditure cycle is temporarily stretching free cash flow. Sembcorp shows 5 consecutive years of increases, but its underlying cash flow is heavily restricted by high debt servicing costs at a weak interest coverage ratio. Reading the dividend trajectory requires looking past the headline yield to verify the consistency of the payment record. We must ask whether the underlying operating cash flow is real and growing, or whether it is being quietly squeezed by debt servicing costs and heavy capital demands that have not fully landed on the income statement yet. The peer comparison table places ComfortDelGro's 6.6% yield and Zone 2 watchlist status directly alongside Sembcorp's 4.1% yield and Zone 4 caution rating. Note that broader sector average data for Singapore Exchange Industrials and Utilities remains publicly unavailable as of June 2026, and these lines will be updated once a reliable proprietary source is secured. Context is everything in forensic investing. An honest gap in the data rows is far more useful than a fabricated estimate that you cannot safely rely on. We focus strictly on the 5 metrics that matter most for capital protection: yield, gearing, interest coverage, net debt to EBITDA, and the consensus discount. Stepping back to look at the broader market data from early June 2026, 3 clear forensic trends emerge. First, we'll see an aggressive rotation to growth names as the Straits Times Index hit an all-time intraday high of 5,150.69 on June 3rd, forcing analysts to hunt in capital-heavy sectors. Second, the widest gap sits in infrastructure names like Sembcorp, where institutional optimism is built on a project timeline rather than today's balance sheet. Third, the single counter that passed all financial health gates, ComfortDelGro, is trading furthest below broker consensus at a 15.1% discount. In summary, ComfortDelGro sits on our Zone 2 watchlist, offering a 6.6% yield that clears all hard gates, a comfortable 29.7% gearing ratio, and a 15.1% discount to consensus, with our eye closely on the August 19th earnings to monitor free cash flow. Sembcorp Industries remains in Zone 4 caution with a low 4.1% yield, 3 major hard gate balance sheet failures, and heavy debt carrying risk until its project completes in 2029. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.